Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we're going to make the best investments that we can, so thank you so much for joining us. And in today's podcast, I'm going to do something a little bit different. I'm actually going to be going through the Up and Down Wall Street column from Barron's magazine. That's the Up and Down Wall Street column from Barron's magazine, written by Randall Forsyth. And it's an article that I really appreciate. Or the column, I should say, that Randall writes for Barron's on a weekly basis. And so something I want to start trying out is taking this article, for example, on a weekly basis, giving a brief overview, but then giving my talking points on it. And the whole idea is looking into what are the current events going on in the market this past week, the upcoming week, and helping us to have like a central place we can go to get an idea for what's going on in the markets right now, like an overall market outlook type thing. There's so many news sources and so many things out there that we can spend our time just getting underwater about. But I want to focus on some high quality ones, bring these to you, and have some talking points around those that hopefully will help you be much more informed and learn a lot as investors as well. And this is the type of content that does just that. This week's article is entitled Tighter Polls Throttle Stocks. We'll talk more about that in just a minute. If you want my show notes from this article, from this podcast, basically my detailed notes about what I think and all that kind of stuff, this is more than you'll get just by going to the website or anything else. If you want this, you can simply text the word family notes, one word, family notes, the number 44222, or simply go to investorinthefamily.com and sign up for the email list, and you will get an email sent to you with links and all the information you need to get signed up for those show notes. So look forward to seeing you there. But today, the article, Tighter Polls Throttle Stocks by Randall Forsyth. A brief overview is that Forsyth is looking into what have been the undercurrents that have been driving the sudden market movements we've been seeing a lot of in the last few weeks. Because they're not really the undercurrents that everyone is blathering about in his terminology. Because everyone keeps talking about Fed this, Fed that. And according to Forsyth, that doesn't line up with the market movements we've been seeing recently. For example, the comments from the Fed don't fit the bill for the blame in terms of the market movement we've been seeing. For example, short-term treasury yields typically are the most sensitive to Fed talk, but they have shown very little reaction of late. So that's one sign showing that this isn't related to the Fed. Number two sign, Federal Reserve Governor Lael Brainerd, I'm assuming Lael is correct. It's a little bit of a name I'm not used to. Lael Brainerd reinforced her dovishness this previous week when everyone was expecting the opposite. Everyone was expecting typically dovish Brainerd to come out and become hawkish, but she actually reinforced her dovishness, which goes to show that would be more optimistic for a rate hike not coming this week, and that would be optimistic for stocks, as has been the trend for years. So if that's not fitting the blame for the big movements in the stock market of late, what is? For example, what is behind the fits that have been in the stock market? One, there's been an unanticipated bounce in yields, which typically has little to do with the Fed. And this is likely linked to expectations related to the Bank of Japan meeting this week. The Bank of Japan is actually meeting around the same time period as the U.S. Federal Reserve this week. And according to Forsyth, it seems as though that may be a bigger driver of movement as opposed to the Fed meeting. Another factor is the dramatic tightening of the U.S. presidential polls. Donald Trump has pulled even with President hopeful Hillary Clinton, erasing what was a 5 to 7 point deficit. And a Trump victory would raise the odds of a more aggressive fiscal policy. For example, Trump has mentioned things like tax cuts, expanded spending, trade and regulatory changes. So all these things would more than likely make for a more aggressive fiscal policy. And so that basically the market senses the potential for higher deficit spending, which would be concerning. And quote unquote, significant sophisticated investors have been positioning for a rise in bond yields, which have been at the core of the stock market's turbulence. And if you're lost right now and some of this doesn't make sense, hang tight. It confuses me too, but I'm going to explain it all in just a minute. So some are also making long shot bets that the Fed meeting this week, they may actually raise rates this week, which is not what anyone's expecting. Supposedly, there's a 22% chance that they will actually raise rates this week, which is not very good. But people are making long shot bets that they may do just that. And they're doing that via option trades where they're basically risking $1 for the chance to make $10 if the Fed does indeed hike rates this week. And so one of the reasons they think they might do that is as a reaction to Donald Trump's critique of the Fed, saying they're just really a politicized, really political wing or arm of whether it be Barack Obama and potentially Hillary Clinton. And of course, they won't raise rates because they're here to help the president and the Democratic Party look good. That's part of the Donald Trump argument. So maybe the Fed will raise rates just to kind of stick it to him and say, hey, that's not true. But the Fed they focus so much on being data and numbers driven, and the data and numbers just do not support hiking rates this week. For example, the August retail sales are falling short of expectations. Core sales are down. Industrial production is down. The manufacturing index is sub 50, which is bad. Means it's not expanding and growing like you'd want it to be. And there's been weaker than expected non-farm payroll gains. That's all related to unemployment rates. And on top of that, rate hike would be too disruptive to global markets, especially global banks, which are at an uncomfortable levels regarding financial stress. They have the financial stress tests that you hear about. They're not at any crazy high levels of financial stress or not performing poorly, but they're still at a level that causing global turmoil by raising rates probably isn't something the Fed is very interested in doing right now. So that's a general overview of Forsyth's article and some of the key points that he's pointing to, basically saying, what's going on behind all the stock market ups and downs recently? It doesn't make sense that it's the Fed. It's most likely related to expectations for the upcoming Bank of Japan meeting this week, and also the fact that Donald Trump has pulled closer to Hillary Clinton in the presidential polls. And if Trump does get elected, which for the most part Wall Street has been not expecting, if he does get elected, that'll be more deficit spending, and that will impact yield curves and all that kind of stuff moving forward, right? So now that you hear that and you're probably still a little bit confused, if you're like me, let's talk through it a little bit. So a few things is, first of all, it's so important to look beyond the surface noise to find real problems and issues. If you go around and you read popular articles, listen to popular news and television, they're going to be saying Fed, 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 Fed. But what if it's not the Fed? Okay, can we say that? Can we acknowledge that maybe the Fed is not behind everything? Granted, the markets are very highly dependent upon the Fed. I'm not about to say that they're not, but what if there's more to it right now? And I love that Mr. Forsyth is looking into that. And so I want us all to do the same thing. And basically, at this point, the Fed has no good reason to raise rates except to shirk Trump's critiques, which doesn't make any sense. And I'm hoping that they have better justification for their decisions than trying to please or displease Donald Trump. And really, like we went through the numbers a while ago as far as unemployment, sales, all that kind of stuff, and they just don't look great. They're not growing. They're not evidencing a growing, thriving economy like you'd want them to be doing if you wanted a strong backdrop to support a rate hike this week. And again, I'm recording September 19th of 2016. So basically, stock market disturbances most likely are due to expectations out of Japan and the tightening presidential race, as I mentioned earlier. Two things that I've not heard many people talking about as far as the relation to the stock market. And basically, a Trump victory would likely bring even larger deficit spending. Actually, the interview released this morning. I'll give you a little sneak preview. The interview coming out next Monday with Doug Eberhardt, talking all about gold and silver. We talk about things going on actually right now in the U.S. government, legislature, and otherwise that's looking at potentially the next 9 years almost being a guaranteed deficit spending every single year. And what will that do to the government debt? Sneak preview for next Monday's podcast. So all that thing in mind, the phrase, Forsyth also uses the phrase significant, sophisticated investors, quote unquote, which I just love anytime someone can say, quote unquote, significant, sophisticated investors. We used to use phrases like smart money, but now we say significant, sophisticated investors. It makes me think like there's some kind of like a stock market mafia out there or something. But if you're like me and you hear this statement, significant, sophisticated investors have been positioning for a rise in bond yields, which have been at the core of the stock market's turbulence. And you think, okay, what on earth does that mean? Well, let's look into it a little bit. According to Investopedia, basically, inflation is a bond's worst enemy. When inflation expectations rise, interest rates rise, okay? Bond yields rise and bond prices fall. To that end, bond prices and yields or the price yields of bonds with different maturities are an excellent predictor of future economic activity. So again, inflation is a bond's worst enemy because when inflation expectations rise, interest rates rise, and bond yields rise, and bond prices fall. So if there's an expectation of, well, here you go. Essentially, the smart money is anticipating inflation, which we have not heard a lot about of late, which show up in rising bond yields and falling bond prices. And all of this is causing some shakeup in equities. So, for the longest time, the Fed and all the developing economies around the world and the central banks are wanting more inflation, most of them around the 2% mark, and are really struggling to get that inflation that they want. And it sounds like markets, the significant sophisticated investors are thinking maybe that could be coming. And that means interest rates or yields on bonds would be rising. And that's what they're talking about when they say significant sophisticated investors have been positioning for a rise in bond yields, which have been at the core of the stock market's turbulence. So basically, they're anticipating that this will happen, okay? And again, if this is still confusing, you can sign up for the email list and you can get the notes that I'm reading from right now and read through them yourself and send me questions. We can talk about it more later on. So essentially, like I said, smart money is anticipating inflation, which shows up in rising bond yields, falling bond prices, and all of this is causing shakeup in equities. And again, if you're confused a little bit, it's totally okay. I'd be lying if I didn't admit that sometimes this makes my brain hurt also. And just to be clear too, the definition of a quote unquote long bond is really the 30-year U.S. Treasury bond, because the long bond is called so because it's a bond with the longest maturity issued by the U.S. Treasury. Because a long bond is one of the terminologies they use throughout the article in discussing some of these things. So again, the big money or smart money is, again, he avoids ever saying smart money, but he says, the sophisticated investor line, and then big money is betting long bond yields will rise as they're currently mispriced. So again, long bond, which would be the 30-year U.S. Treasury bonds, will rise because they're currently mispriced or undervalued. Okay, so the only reason I can see the Fed raising rates is simply to save face, because they can't really see, and I can't really see it happening before the election, regardless of any Trump accusations. But the Fed has talked about raising rates so many times. If they don't raise rates in the relatively near future, meaning the next 6 months or so, people are going to lose almost all legitimacy with everyone. And so I could see them potentially doing a 0.25% rate hike and then being one and done and then moving on, because I don't see any economic support for this to happen at all. So really the big news is Japan and the presidential race, and both are really amazing case studies in desperation and no good options. So that's my walkthrough for the Up and Down Wall Street column from Randall, Forsyth, and Barron's magazine. And hopefully that'll help you out as far as market outlook, as far as what's been going on in the markets, why the equities have been so up and down of late, and maybe what to expect a little bit more going forward. So again, I hope you enjoyed the show. And remember, if you would like show notes, you can simply text the word family notes to the number 44222 or go to investorinthefamily.com and sign up for the email list, and you'll get these detailed notes that I've been reading from myself for this podcast. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.